If you ask anyone on Wall Street what the biggest threat to the American economy is right now, they'll probably point to the housing market. They'll talk about 7% mortgage rates, inflation, and a generation locked out of homeownership. But they are looking in completely the wrong place. The next 2008-style financial crisis won't start because people can't pay their mortgages. It will start because they can't insure their homes. And the smartest money in the world has already quietly started packing their bags. To understand this invisible crisis, we need to look at a fundamental rule of the U.S. financial system. You cannot get a mortgage without home insurance. It is a legal requirement by every major bank. For decades, insurance was an afterthought, a cheap, boring piece of paper. But insurance is ultimately just a mathematical model of risk. And right now, the underlying data of that model is fundamentally broken. In states like California, Florida, and Texas, which represent a massive chunk of the US GDP, the risk models have flipped. The cost of rebuilding has skyrocketed, and the frequency of natural disasters has broken the algorithm. The result? The biggest insurance companies in America, State Farm, Allstate, Farmers, are doing something unprecedented. They aren't just raising prices. They are abandoning entire states completely. But why now? Why are multi-billion-dollar corporations running away from paying customers? The answer lies in a hidden sector of global finance called reinsurance. Yes, insurance for insurance companies. When a massive hurricane hits, your local insurance company doesn't actually pay the billion-dollar bill. They pass the loss up the chain to global reinsurance giants. But these global giants have looked at the macroeconomic data. They've run the long-term predictive models. And they've realized the math simply doesn't work anymore. They have drastically raised their rates. This forced local insurers to either charge homeowners $10,000 a year for basic coverage or simply leave. Millions of Americans are now entering what economists call the doom loop. Let's play out the macroeconomic reality of this doom loop. Step 1. Your home becomes uninsurable, or premiums become more expensive than your mortgage. Step 2. Without insurance, banks refuse to issue new mortgages for your house. Step 3. If nobody can get a mortgage to buy your house, your property value instantly collapses. Your home is now only worth what a cash buyer is willing to pay. Step 4 is where it becomes a national crisis. Regional banks across America hold trillions of dollars in these mortgages on their balance sheets. If the underlying asset, the house, loses 40% of its value because it can't be insured, these regional banks become completely insolvent. In 2008, the financial system crashed because Wall Street built a house of cards on bad loans. Today, the loans are fine. The people have jobs. But the physical world itself is rejecting the financial models we've relied on for a century. The ultimate question isn't whether this bubble will burst. The question is, when the private market walks away, will the government step in with taxpayer money? Or will millions of Americans watch their greatest financial asset go to zero? Thanks for watching. We'll see you in the next one.